Imagine a salesperson knocks on your door and offers you a solar system. The installation will cost $25,000. In return, they claim you'll save thousands of dollars on electricity over the coming decades. The question isn't whether you'll save money. You probably will. The question is whether those savings are worth $25,000 today. Because every dollar spent on solar panels is a dollar that cannot be used elsewhere. It cannot be invested, it cannot be used to pay down debt, it cannot be placed into retirement savings, and it cannot remain available for future opportunities. This is where financial decision-making becomes more sophisticated. In this video, we're going to answer a simple question. How do we determine whether a solar panel installation is actually a good investment? The answer is net present value. And by the end of this video, you'll be able to build the entire analysis yourself in Excel. Most people evaluate solar systems using a simple payback period. They might say the system costs $25,000, it saves me $2,500 per year, therefore it pays for itself in 10 years. That calculation seems reasonable, but it ignores one very important fact. Money has time value. Receiving $2,500 10 years from now is not the same as receiving $2,500 today. And because of that, simple payback often produces misleading conclusions. To properly evaluate the decision, we need to account for the timing of future cash flows. Let's begin by identifying the cost. Suppose a homeowner receives a quote, solar system installation, $25,000. This includes solar panels, inverters, mounting equipment, labor, permits, and electrical work. This becomes the the year zero cash flow. In Excel, create the following structure. We have years 0, 1, 2, 3, 4, all the way up to 20 in our first column. Then create a row called initial investment and enter year 0, negative 25,000. The negative sign indicates a cash outflow. Now we estimate benefits. Suppose the homeowner currently spends $250 per month on electricity. Annual electricity costs will therefore be $3,000. The solar installation is expected to reduce these costs by 80%. So, annual savings become $2,400. In Excel, create a row called Annual Electricity Savings and enter $2,400 for each year of the system's useful life. Solar systems are not completely free to operate. Potential future costs include cleaning, repairs, monitoring systems, inverter replacement. Suppose annual maintenance is $100. Expected inverter replacement in year 12 is $3,000. Create a row called Maintenance Costs and enter these expected future cash outflows. Every anticipated cost must be included. Ignoring future costs can dramatically overstate the attractiveness of the investment. Step 4, estimate the terminal value. At the end of the forecast period, the solar system may still possess value. Potential sources include remaining useful life, salvage value, additional home resale value. Suppose we estimate that the terminal value of the system is $5,000. This value appears as a positive cash flow in the final year of the analysis. Many people forget this step entirely. Step 5, choosing the discount rate. Now we arrive at the most important assumption in the entire model, the discount rate. Most people simply choose a number. That is a mistake. The discount rate should reflect opportunity cost. Ask yourself, if I don't install solar panels, what would I do with the money instead? That answer determines the discount rate. Suppose you owe money on a credit card charging 20% interest. Paying off that debt generates a guaranteed 20% return. The opportunity cost of installing solar panels is therefore very high. Under scenario 2, let's say we deal with mortgage prepayment. Suppose your mortgage rate is 5%. Every dollar invested in solar could instead reduce mortgage interest. A discount rate near 5% may be appropriate. Scenario 3, long-term investing. Suppose the alternative is investing in a diversified stock portfolio expected to earn 8% per year. An 8% discount rate may be reasonable. The correct discount rate depends on the investor, not the solar system. Discounting future cash flows. Now we convert future dollars into today's dollars. Each year's cash flow is discounted using the following formula. Present value of the cash flow is equal to the cash flow at year 1, year 2, whatever the case may be, divided by 1 plus the discount rate raised to whatever year we're on. Excel performs this automatically. Future savings that occur many years from now contribute less to today's value than savings that occur next year. This is the fundamental principle behind present value. After discounting all benefits and costs, we calculate the net present value to be equal to the present value of the benefits minus the present value of the costs. If NPV is positive, the project creates economic value. If NPV is negative, capital can likely be allocated more effectively elsewhere. Notice that this does not mean the solar system loses money. It simply means another use of the capital may create more value. Section 9, building the entire model in Excel. Your spreadsheet should now contain rows: initial investment, electricity savings, maintenance costs, terminal value, net cash flow, present value, cumulative present value. Columns should be years 0 through years 20. Once complete, Excel can instantly calculate the payback period, the discounted payback period, the net present value, and the internal rate of return. The entire investment decision becomes data-driven rather than emotional. A solar system installation is not fundamentally different from any other investment. It is simply an upfront cost exchanged for a stream of future cash flows. The question is not, will I save money? The question is, are those future savings worth more than the capital required today? And that is exactly what net present value was designed to answer.